Hi everyone, welcome to the Propel podcast. Today I wanted to welcome Matt, who's a good friend of mine, a mortgage advisor, and he's going to be talking through his experience and hopefully telling us a few interesting facts.
Thanks for inviting me on. So essentially, a bit about me and my background is probably useful. So I started out my career at Coutts, various roles, so straight in from school. I was at Coutts. I started off ordering things like checkbooks, setting up people's standing orders, direct debits.
You're showing your age there.
Yeah, so I was So I was doing that, and then various different roles and teams within the bank for around 15 years. And then I finished as a banker. So a banker essentially had my own client book. Of retail clients, so high net worth and ultra high net worth. And at the time, I was working a lot in the legal sector and accountancy firms. So I was doing a lot there, dealing with partners, was one of my main client base. And then after about, I was at Coutts for about 15 years. After that, I left, took the decision to leave. And during that time is actually when we met, because that's when I got approached by Oaknorth to go over there and help with some projects.
And we worked together. So me and Matt worked at Oaknorth for several years. And it was a really interesting time because I came from Lloyds Bank and you came from Coutts, so we're both corporate backgrounds, and went into this startup, which was just chaos, like amazing, but chaos. Yeah. And it was growing at such a phenomenal rate. I think the first week I joined, we were in the Mayfair office, and a few weeks later we were in somewhere else, and we were upgrading offices. And then I think you joined a few weeks later after that. And we're just doing loads of projects, got loads done. I think when we started, there was about 100-ish employees.
I don't know, it wasn't a lot in the UK.
Yeah, it wasn't a lot in the UK, and then it tripled or quadrupled while we were there over the next couple of years. And it was a really great experience. Met lots of very interesting characters. Yeah. A lot of people have gone on to do amazing stuff as well on the back of that. So it's been really good. And your journey after Oaknorth was, what did you end up doing?
After Oaknorth, I then went and joined up with some old Coutts colleagues who set up Dendro Private Wealth, which is where I am now. So I've been with them, essentially went over there to head up the mortgage proposition at Dendro. More recently, so I've been doing that for 6 years or so, and then more recently I've transitioned a bit more into like a wealth manager role. So I'm also doing, alongside heading up the mortgage team, I'm doing some investments and pensions and protection pieces as well, which is interesting. But my main day-to-day is very much mortgages still.
Perfect. As an expert in the field, what's your predictions on interest rates over the next few years?
Expert is very kind of you. I think interest rate wise, everyone will say the same. It's like a crystal ball moment. You have to look at the data, I think, just to get a feel for it, what may be happening. So it's perfect timing, so much as they've just released the inflation data, which has come out this morning at 3.8. It's been 3.8 now consecutively for the last 3 months. It's slightly less actually than they thought it was going to be. They thought it would be 4%, so a small
2%,
a small win. But so that's positive that it's holding, but clearly it's not anywhere near the Bank of England's target of 2%. So the economists have essentially said that now they think that base is going to be held where it is. I think the next meeting's start of November. That the base is going to be held where it is, and then potentially Q1, maybe Q2 next year, it might go down slightly to 3.9, so 10 basis points or whatever, but it's broadly going to remain where it is.
Do you see that for the foreseeable future, or do you think that's a temporary measure to get inflation back down?
They want to get inflation back down as a government. The Bank of England have always done what they need to do. A perfect example is December 2021 to August 2023, the Bank of England, the Monetary Policy Committee, did 14 consecutive rate rises just to get the inflation down from 11.1%. So they will do what they need to do. There is obviously, it's not as simple as that, because clearly there's the stuff overseas from Trump and his tariffs and what impact that's going to have on us. But it's probably going to remain as is, I'd say.
And I think we've grown up in a time over the last 20 years where interest rates have been low. But that, if you look over a 100-year period, has not been the case, right? Interest rates have been significantly higher, and now still a relative medium or low average interest rates from Bank of England. So in the longer term perspective, this is probably the environment we'll be in for the foreseeable. Yeah,
very much so. That just feels like it's going to be the norm going forward. When it feeds into mortgage rates, obviously people always ask the same question, which is Bank of England have moved their interest rate. What does that mean for my fixed term deal? Fixed term deals, whilst they do have a bearing, they're actually priced on the back of something called SONIA rates, which is the old LIBOR, which is what the banks borrow money from each other on. And then essentially they're what you want to keep an eye on if you're thinking about fixing and how best to price, because it's the margin that the bank takes above that SONIA rate, and that's how they're priced off the back of.
Okay, and in terms of the political output, right? So obviously we've got the budget next month, everyone's talking about tax rises, right? And I read a stat this morning that said that we're now paying 100 billion a year in interest payments alone. If Bank of England do raise interest rates, it's quite interesting because it's actually in the detriment to the government, because if they increase interest rates, that means that our repayments of the interest, repayments on the debt are going to go up, and inflation will go down, but inflation actually helps them erode away their debt as well.
So they're torn, essentially, as what to do. So but they do need to get inflation down to more that target level of 2%. So it'd be interesting to see what the autumn budget has in store.
And the Bank of England is independent, right? So they will act independently, but it could be an interesting debate. So for the followers of Propel, obviously mainly landlords, right? How do you think interest rates and the general economic environment is going to affect properties over the next few years, property prices and landlords?
Good questions. Again, I think all you can probably do is just have a look at what's happened. Whilst we've discussed interest rates already and what our thoughts are there, I think we probably need to look back a little bit. So, for example, during the pandemic, there was a real property boom. It was a good environment for that, so people wanting to move. There were low interest rates, inflation was at a steady level, so there was a lot of transactions going through, which therefore essentially there was a bit of a spike in property prices. I think what we've seen now in more recent years is it's fallen away a little bit. I think towards the end of 2022, 2023, because of the increases in interest rates and people having to tighten the purse strings a bit. But then what's happened now, and more recently, is that I think it's gradually getting back to a steady level, is what we're seeing. So the growth isn't as aggressive as it was during the pandemic.
Do you think the growth will still maintain over the next few years?
Yeah, so economists, again, they think that property prices will continue to grow. It's tricky at the moment for renters because there is still a real demand for renters. They are seeing the price of rentals drive up, but that's mainly because the cost of borrowing is so high. And
this is what people forget. This is a really interesting point you touched on there, because as a landlord myself and someone who's pro-landlords, right, it's what a lot of people seem to forget is that anything that is to the detriment of the landlord is actually to the detriment of the tenant, because if you increase taxes or costs on landlords through increased regulation, increased compliance, increased interest costs, it's not that the landlord's going to eat that cost, they're going to pass that on to the tenants. And that's just this general state of how economics work. So actually what they're doing is increasing the cost to renters.
Yeah, potentially it does all stack up, but that's what's surging, I'd say, the price of, and also a lack of supply.
Yeah, because a lot of landlords are exiting the market.
So they're exiting the market, and also there is obviously a shortage of homes in this country. So the shortage, so there's the shortage of property in the country, coupled with an affordability issue, so in so much as interest rates are not high, but they're higher than they have been, and wages and everything else feeding into it, it's driving the rentals. Yeah, so it's been a real mixed bag when it comes to property prices. So it's highlighted more in the latest house price index figures that have come out from Halifax. So essentially they're saying that property prices have fallen 0.3%, where Nationwide have said they've increased 0.5%. So it's all quite flat. The reason for the difference is predominantly because of the data that they use their own transactions to get that data. So in order to get a real feel of what's going on in September for the housing price index is probably to wait for the Land Registry's figigures that are due out on the 19th of November.
Perfect.
Yeah.
I know that there's a bit of a lull at the moment in the transaction market. What's causing that, and what's been the trend recently?
So I'd say that during the month of March this year, there were a lot of people trying to get transactions through due to the changes that were coming with stamp duty. So there was a real spike in transactions. Since then, it's fallen away a little bit, and as we're starting to pick up, the government have now announced some potential changes that are coming in the budget on the 26th of November, which has therefore the market a bit. So everyone's waiting to see what's happening with that. I know they're speculating that changes to stamp duty. So anyone who owns property in excess of £500,000, what they'll then do is they'll essentially charge like an annual tax on that. So people around that level are just holding off, waiting to see what that looks like.
It's really interesting that, because I know it's a big if whether they do that or not, but what if they did bring in something like that? What do you think would happen to the market in the short and long term?
The stamp duty changes? It's really difficult to say. So I think it will probably stimulate the market.
Because it's a lower amount of cash.
Because it's a lower upfront, so there will be some natural growth there personally, it's what I think. But longer term, I don't know what it looks like. So I don't know. Clearly, the thought process is they don't want people sitting in big, large properties paying the annual premium when they don't need to live in it. So they're hoping it frees up some bigger properties. I understand that, but equally, it's that coupled with the potential changes they're talking about to charging capital gains on your main residence, which has always been exempt. So there's a lot of things that have been speculated where now people are thinking, okay, let's just wait and see what happens.
Yeah, I know the regulations changed a lot, and the way bank lenders look lending to landlords has changed a lot, and they're moving to this debt service coverage ratio. So how does that work if you buy a buy-to-let in your personal name versus in a company name?
Yeah, fine. So it's slightly different calculations. So ignoring the fact that a few lenders might have minimum income requirements aside from the rental, if you just look at, say, a personal transaction, is that what quite a few of them do, it's not the same for all, but quite a few of them would do. If you're a basic rate taxpayer, they'd look at a interest cover ratio of 125 times whatever the debt is and the rental that you're getting in. So it's got to cover it 125 times. And then if you're a higher rate, it might creep up to 145 times is how they calculate it.
So so if you own it in your personal name, it's 125% off the rent that you...
Correct, yes. So essentially the rental that you receive has to be able to cover 125% of the debt.
So if your rent for the year was 10 grand, you have to show 12.5 grand.
Yeah, that's exactly it. So there has to be a surplus, but it's not as easy as that, because what they will do is, it depends on the product. So for example, a 2-year product is stress tested differently to that of a 5-year potentially. So it's not an exact science, but a 2-year would probably be stressed at say 3% more than the pay rate. And then a 5-year fix predominantly stressed at the pay pay rate.
Okay.
So if it's out like 5.5% 5-year fixed, it'll be stressed at 5.5%, or if it's a two-year at 5.5% for ease, then they'll stress that at 8.5%.
8.5. Okay, all right, that makes sense. And is that through a company? What's the ratio they use?
So because it's for a company, they just do, it's the same calculation, but all they do is it's based on 125%. So because it's through a company, there's no higher taxation applied.
And if you are a landlord who is full-time or working, what is the minimum income thresholds typically lenders look for?
So it varies. Some of them haven't got any, whereas others have got, who are the main high street, have got minimum income requirements of say 25,000. They're not massive, but they do want to have some other income coming in addition to the rental.
Okay, and just to talk through a few different scenarios, right? So if you're a landlord or wanting to become a landlord, do you have to own your own property first, or can you go as your first property buy to let through a company? So
first time buyer, first time landlord. There are a few lenders that do it, but not many. It will be affordability based, because what they don't want people doing is essentially a backdoor buy to let. So saying that you're going to let a property and then actually moving into it yourself, that will be the fear, because it's clearly a way that you can almost bypass the affordability.
Okay.
So that doesn't happen, so it will be affordability based.
Okay.
They'll look at what your personal income is to see if it's affordable as a first point of call on that basis, and then if it is, and they know that's there, then they then can look at the calculation.
Okay, all right. If I was a foreign investor and I'm looking to buy in the UK, can I get a mortgage?
It depends on your status, like an expat mortgage. First thing to say is, for us as a firm, you'd have to be on UK soil to entertain any kind of advice. But it's very difficult as an expat. So a lot of people are moving to Dubai, as an example. Ignoring the geography for a moment, because of Brexit, a lot of banks now, their banking licenses have either been pulled or changed or whatever the case. It means that lending in other, or obtaining finance in another jurisdiction is really difficult.
Okay.
So a lot of lenders are just pulled from the market.
So they just don't lend to people who aren't UK based?
Yeah, they will not lend to anyone who's not UK based.
So I've also seen that there's lenders now that are providing products where they provide a bridge to help landlords buy auction properties or properties that need to be developed. That will then be automatically refinanced into a buy-to-let mortgage. How do they work, and what's your opinion on those?
Yeah, so they've replaced the bridge really. So what obviously people historically did was buy a property, say at an auction for example, they'd bridge it, so they'd complete the transaction within the set time frame, and then they'd do the work, and then once it's all done they'll refinance it. Whereas now a few of the lenders, what they let you do is that they would essentially give you the loan on a renovation basis. It's normally relatively light touch, nothing too heavy when it comes to refurbishment, and they'd let you do the works that you need to do to get the property habitable.
And do they lend you for the works as well?
They can lend you for the works, so they can potentially offer you some financing towards it depending on what needs to happen. So yeah, and then what happens is once all the work's been completed, they'll charge you a bit of a premium on the product during that time, and when it's all finished, they'll then say okay fine, and they'll revert you to their standard buy-to-let terms.
Buy-to-let terms, okay. Thanks everyone for joining the Propel podcast. It was great to have you, Matt. Some real good insights in that. And if anyone's interested in getting some financial advice or talking about mortgages, we'll put Matt's details in the description below.
Thanks very much.